de fiscalité, est-ce que vous préférez les instructions en français? Do you prefer the instruction in English?
Yes, please.
Yes, please.
In English? All right. Each team has 20 minutes to present its case to the judges. I will show board of the 10, 5, and last 2 minutes and 30 seconds remaining of the presentation. During the last 10 seconds, I will show them to you with my 10 fingers. A team having in this presentation after 20 minutes will be stopped to move on to the period of questions. A period of questions of maximum of 5 minutes is assigned to the jury, and at the end of the presentation, I would like to remind each judge that it's mandatory to ask at least one question during the period of question. Please note that you cannot reveal the name or source of your university, as you may get disqualified. I would like to ask the public to turn off the ringing of their cell phone right now. I will now invite the judges to introduce themselves, and you'll be able to proceed to the presentation.
Bonjour, Catherine Desharnais, coordonnateur de gestion financière.
Francis Gros, tax advisor for KPMG.
Simon Caron, candidat CPA de comptable chez Fiscalite.
According to one of the smartest men who's ever lived, the hardest thing in the world to understand is income tax. Mr. Lambert, our team and I, myself, Titiana, along with Vincent and Guanfu, are here today to answer some questions regarding one of our oldest clients, Monsieur Doucet. So what are we here for exactly? Essentially, we're here to firstly and most importantly, talk about the retirement strategy for our client by looking at his tax payable, along with the investment alternatives that we have, and lastly, the sale of the company that he has been working at for years. We're going to do this by splitting up in 3 sections. As you can see, income tax payable firstly, then the investment alternatives, and lastly, the other considerations that we'd like to tackle as well, including the car of his wife. So with that being said, what does our corporate structure look like at the moment? So our client, Jacques Doucet, currently is the sole shareholder of Dr. Doucet Inc. So he has been working there and controlling this for many years now. He's looking to retire, wants to go golfing, and he's trying to figure out what the best tax strategy is in order to properly be able to go ahead and sell his company. So with that being said, I'll pass it on to Vincent, who's going to start with income taxes.
Thank you, Titiana. So basically, one of our main mandates today was how much do you actually have to, or how much do you have to pay in 2018? Well, first thing, just to recap the steps. You have to reconcile the net income for tax purposes, because you have to make certain that you differentiate the difference between GAAP net income and net income for tax purposes, which has different deductions. Then we go into the Division C deductions based on certain deductions that are only eligible for the corporation. And finally, actually the number crunching with the actual rates, applying the taxable income with each rate based on the type of income. So the first one, the client gave us his financial statements. One of his deductions on his GAAP net income was his life insurance. Unfortunately, there was not that much information as to why there was life insurance, but for a business, for tax purposes, it has to be required by the bank in order to be deductible for tax purposes. There's also another deduction for meals, 50%. Amortization, we assumed in this situation that it was equal to CCA because we didn't have any information, but if you actually want, based on the breakdown of your assets and which CCA class and how you can calculate it, we can do it in Q&A afterwards. So next step, Division C deductions. You take your net income for tax purposes, which in tax lingo is Division B. In this situation, there was nothing, so Division B is equal to Division C. So now the number crunching, the base rate, the federal tax abatement, and the entire amount was eligible for the small business deduction. You also, based on his financial statements, there was rental income included in his income, so that was you had to pay additional refundable tax on that, which was a 10.67%. And even after all that, there was still some left over, so it had to be taxed at the general rate reduction. So that's actually pretty good because it also would be added to your GRIP account, which can actually be paid out to your shareholders as eligible dividends going forward since you paid the tax at the highest rate. And also the additional refundable tax also means refundable, so approximately $3,000 is added to your refundable dividend tax on hand account, which is basically a refund to the corporation when dividends are paid out to their shareholders. Another thing that caught our eye in the financial statements was the fact that there was actually a balance owing in 2017 and 2018. They didn't know exactly how much they had to pay. We just wanted to clarify or make certain that it was paid, and if not, the client might be responsible for a 6% penalty compounded daily and a penalty for 5% plus 1 per month, which can be doubled if it's a second offense. So now I'll leave the floor to Guang Fu to go over your investment alternatives.
All right. So the investment alternatives, right now there are 2 current options provided to us. First one is to invest in real estate. And the second one is to invest in US stocks, which is a private corporation. Well, we're going to tackle that by calculating the cap rate, the NPV of each of the project, and also to talk about other qualitative income tax factors. First of all, the real estate investment. So in order to calculate the cap rate, we need to normalize the income for the year. So what we're given here is all the total income for the generated by the property. We assume it's going to be a 95% vacancy rate, and adjusted by the net income, we calculate also the tax portion of it, and the net after tax adjusted net income is $53,000 on a yearly basis. Moving on with that, we have the normalized profit, we have the property price, we got the cap rate of 3.5%. Now look at the NPV. So we want to take it a bit further and see how much are we really, how much is this project, this investment really worth. And what we have discussed is that we'll look at the next 30 years, because right now Monsieur Doucet is around 60 years old. So we're really focusing on the next 30 years of the cash flow generated by this investment property. So we have the NPV of around $1.1 million. That is assumed with a 2.5 interest rate, which is a pretty standard T-bill rate. And we assume that the growth rate of the income equals to the inflation rate. So what's some of the more tax implications on this income? Well, first of all, usually investment in real estate is more resistant when it comes to business cycles. So it's a bit less risky. Another thing is it does generate a steady return in the future. You're able to claim relevant expenses to reduce income. For example, maintenance, interest, property tax, etc. When essentially, in the end, when Monsieur Doucet wants to sell the property, only 50% is taxable on sales. And the loss, should it happen, if there's going to be a loss, the loss can be deducted against any type of income. And the only one drawback on this one is a liquidity issue, because it is a pretty big down payment. Moving on to the US startup investment analysis. Well, so we also did a calculation of the net after-tax dividends payout ratio. So we have all the information being given: semi-annual payment, 1.3 of exchange rate after tax, which gave us the 3.15%. It's slightly lower than the cap rate we have. But what about return on equity? Because we're provided on the information that there is a 10% growth on the corporation. So from corporate finance, we know the payout ratio equals to G divided by ROE minus by 1, which gave us a ROE, return on equity, of 10% adjusted by tax, and also taking into consideration of the growth rate in the future. However, this figure is much higher than the 3.5 cap rate. However, is it really reliable? But the information on 10% of the growth rate is given to us by essentially the relative, and we're not too certain on how much is actually going to be the increase rate. So we want to be a bit more conservative because the money is used by the retirement fund. So we assume that the current PMT, again adjusted by the tax, of 44,000 and get the NPV of 940,000. And if you compare both of the NPV, this one is slightly lower than the first investment in real estate. So what about tax implications here? Well, first of all, the investment in US, especially a startup in tech, is much more riskier. So we don't think it's the most ideal way for your retirement funds. Another thing is it's a US corporation paying out dividends, so you're not eligible for the dividend tax credit in Canada. For retirement purpose, and also there could be potential issues on disputes. And if we compare the NPV, we conclude that essentially the best way to invest this money is by the real estate investment. Yes.
So now, one of the other considerations that was really important that we had to tackle today was, first of all, the disposal of his company. He didn't want it anymore, and the fact that his spouse was actually receiving vehicle benefits and didn't really know how to proceed, what would be the most optimal solution for her going forward, basically. So the first thing, the sale, he wanted to dispose of his shares. Main thing that we really have to determine in the beginning, because it affects the rest of our calculations so much, is Dr. Doucet Inc. a qualified small business corporation? There's 4 main criterias. Usually the 3 first ones are usually met all the time because it's a small business and usually they're met. The really trickier one is the 90%, so we actually have to dive into it a little bit deeper to determine if that 90% was met. So we did the analysis. Actually, we had to, based on the fact that we didn't have the fair market value of all the tangible assets on the balance sheet, we assumed that it was equal to, that net book value was equal to fair market value. It's not a super valid assumption, but so for that reason, right now, based on this assumption, you do meet that 90%, but just know that all the other non-active assets is the cash, and there was no mention of a CDA, but he could obviously pay it out as a CDA, which is tax-free from his capital dividend account, and you also have RD2H and a GRIP account, so you can pay out eligible dividends to lesser the tax impact on your dividend payments. So based on our assumptions, we said, even though it's a little bit trickier to go through all those assumptions, the real important thing to determine now is that no other work is determined based on these assumptions, and you can sell it tomorrow if you want to. So now I'll leave it on to my lovely colleague Tatiana to go over how to sell it.
Alright, so Mr. Doucet made it clear that he wants to dispose of his company in order to go ahead and retire. So he'd like to retire by the end of the year, and in so doing, he'd also like to do it in a way that will maximize the amount of money that he'll possibly get in the sale of his company. There's one thing here we want to make very clear, that there is a buyer, Dr. Boulanger. However, Dr. Boulanger has made it very clear to Mr. Doucet that he will want to purchase the shares as long as certain assets are not in the shares anymore. So there are certain assets within the company that he does not need. So essentially there's 3 ways that we can go ahead, 3 main ways we can go ahead to sell the company. We're going to look at the first one, which is the sale of the shares themselves. However, as I said, before we can actually just go ahead and sell the shares, we need to take, look at the situation that he does not want to have certain assets. So how are we going to go ahead and tackle this problem? There are 2 ways essentially that we can get rid of the assets within the company. The first is very simply to just sell the assets to an external third party for fair market value. And the second one, which is a little bit trickier, is the transferring of assets to a holdco using an 85-1 rollover. So we're going to look first at just the sale of the assets to external party. Based on the balance sheets and these assets that the buyer does not want, these unwanted assets include cash, accounts receivable, and consultation material. So there's not that many assets essentially that he's not really looking to buy. The big one that the buyer wants, of course, is the actual building where he runs his company. So looking first at cash, I mean, he can just pay himself through dividends. Again, as my colleague mentioned, for CDA eligible dividends, that's something that he needs to take into account. The accounts receivable, what he can do here is factor them, so essentially sell them to another company that will purchase the accounts receivable at a lower cost. So he'll have a little bit of a lower income based on the accounts receivables worth, but it's a good way for him to get rid of it and still have income there. And the last is the consultation material, sale at fair market value. Unfortunately, we don't know the fair market value, but we can go deeper into that if you'd like. So the second one is actually transferring the assets to a holdco. So we do this using an 85-1 rollover. So essentially, what would happen here is that Mr. Doucet would have to create a new company, incorporate a company which we have called holdco. And the unwanted assets, so the 3 assets that we spoke about, would essentially be transferred into the holdco at tax value. Therefore, the tax implication during the transfer would not be immediate. So as I said, unwanted assets rolled over. He would not take any boot because, again, we're not looking for tax. We don't want any immediate tax implications. Just quickly, there were 3 assets that we said. The cash cannot be rolled over, so that's something we really want to make sure that he's aware of. The accounts receivable, we're going to file for a Section 22 election should he choose to go ahead and roll over. And lastly, the consultation material we're going to transfer at UCC. That's going to be our elected transfer price. Again, we don't have the actual numbers, but we can speak to Monsieur Doucet to properly get informed of what that election transfer price would actually be. So there are a lot of cons with doing the 85-1 rollover. Firstly, it's very expensive to actually go ahead and incorporate a new business, especially for him who's looking to retire. And secondly, there will be the assets, the unwanted assets left in the holdco. So not only does he have a new corporation, but he's going to have assets that he's going to have to deal with as well. Also, should he choose to close down the holdco, essentially get rid of the assets within the company, there's going to be wind-up costs when he wants to retire. So it just causes a bigger headache for Mr. Doucet, which is something we want to avoid. Election is required. It's a kind of a complicated situation for 3 assets, one of which is cash. So with that being said, the cost and complexity of an 85-1 rollover are not worth the tax deferral on the sale of the assets. So it is an option, however, we don't recommend that Mr. Doucet go this way. So our recommendation here is really the sale of assets to an external party based on fair market value. So once we sell the shares, we look at the fair market value of the shares minus the assets that he's removed, that we've assumed sold to an external party, gives us an adjusted POD of just over 1.3 million. So looking at this, minus the ACB, there's one thing we really want to do is utilize that lifetime capital gain deduction. It's very important that we use it because we don't know when the government's going to come in and remove this. So we want Mr. Doucet to be able to utilize this. So after this utilization of the lifetime capital gain, he'll only have a tax payable of $80,000. So in comparison to the $1.3 million he's getting, we've actually saved him a lot of money by doing it this way. And again, he's not tied to the company, there's no wind-up cost that the holdco has, etc. It's a simple transaction. There's also the sale of the assets, which might be better for the buyer because he can just come in and choose what he wants, but there's a lot of cons here for our clients. As I said, he's going to be left with assets that he's going to have to dispose of. There's less income here because of a higher tax because there's no utilization of the lifetime capital gain deduction. So the sale of asset is not something we really want to go for. And the last one, so as I said, there's also wind-up costs because there's assets left into the company. So these are costs that are incurred that we want to try to avoid. The last one is the actual redemption of shares. So Mr. Doucet would redeem his shares and then the buyer would come in and buy them. The problem here is that, again, no lifetime capital gain deduction, which is something we want to utilize. And we're not sure exactly if the company even has enough liquidity to pay him for the redemption of the shares. So, in conclusion, we are choosing the sale of the shares as being the best option for Mr. Doucet. One thing, the buyer does have leverage here because of the lifetime capital gain deduction and the possible hidden liabilities because he's selling all of his shares. So Mr. Doucet might have to accept a lower price, which is still okay because even with the lower price in comparison to the other methods, he'll still yield a higher income based on the method that we're suggesting. So with that being said, I'll pass it on to my colleague who's going to talk about the vehicle.
Okay. Sure. So right now the current situation is that Jacqueline, she's being reimbursed by the employer and the reimbursement is never taxable. However, on a yearly basis, she is paying out $2,000 for the fuel expense. So that's a current situation. If we're talking about vehicle benefits provided by the employer, there are 2 ways to calculate it based on which situation it is. If it's owned by the employer, then the standby charge is 2% times the cost of the car times 12 months, which gives us $7,000, which will be added on top of your income. And the operating benefit will be around 1.3 thousand. If it's leased, will give us a much lower tax benefits added to your income. So it will be around $3,000 and the same operating benefit. Another thing I want to talk about here is that because the majority of the use of this vehicle is by professional use, so she's eligible for the reduced standby charge, which is essentially the personal amount divided by 1667 times 12 gives us the reduced amount $831, and also the reduced operation benefit is also the $831. So, to conclude and compare, $1,600 will be added to the income. However, she doesn't need to pay $2,000 on cash, so it's recommended that she use the company car going on forward.
So basically, Mr. Nalbaya, after you giving us an urgent email that you really wanted to get this done as quickly as possible, today, with the urgent matters, we are here to determine the best tax strategy and retirement strategy for Mr. Doucet going forward, in addition to calculate his 2018 tax payable so that he doesn't have to actually pay penalties and interest on all of those amounts, and which of his best alternatives he should go forward, going further during when he retires. How should he use his money to maximize his return on investment? So the income tax payable, we calculated his income tax payable. We also determined how much he actually has to pay if ever he doesn't pay in time, given his corporate deadlines. For the investment alternatives, we calculated net present value of both investments, really bringing those future cash flows to the present value to really have a better idea of how much he's really going to make on this in the present dollar. And finally, the other considerations that we tackled were how to sell the property and the most tax efficient way of selling that property through the use of the lifetime capital gain deduction, and the vehicle benefits that now he will 100% be aware of everything and be certain to make the right choice when determining, when talking to his employer about if he wants to have the employer own it or lease it to his wife. So we thank you extremely for your time, and we open the floor to questions.
So for the car,
Yes.
yeah, you gave us the taxable benefit, but with how much it cost to my wife, like in money, is it the same option I take, or it's because now it's just a taxable benefit, but it's not what I will pay. So.
Well, yes. So essentially, the company mentioned that they'll provide the car. They'll provide the car and essentially pay for all the expenses other than the field. So what we calculated is a taxable benefit by the employer providing the car. From her side, all her cash net outflow will be the $2,000 of the fuel expenses she pays annually, as compared to before she pays like $8,000 on a yearly basis.
I have a question concerning the 90% rule.
Yes, sure.
If you go back to slide, I think it's 25 or 6.
That is great.
You made an assumption concerning the fair market value.
Yes.
For the asset as well.
For which asset? Sorry.
For most of all the assets.
Okay.
Yeah. But like if we see the bottom line for the fair market value, it's 900.
Exactly. Current, based on the
But
financial statements.
the buyer is willing to pay 1.5 million. So where's the gap between the 900 and the 1.5 million?
Well, that's the fun thing about business. There's so many factors that can actually affect the value, the intangibles, the management expertise, the actual value of the brand. That Doucet brand he might have a bunch of customers that are literally always attached to that brand, and that's why there's a really significant difference between the actual fair market value and the actual value of just the assets that he owns.
I understand.
Yeah.
If I sell the company, and you said that I may add some penalty to maybe, I don't know, but can I be responsible for after the sale?
Yes, so essentially there is hidden liabilities that can pop up once the sale is done. So you can be responsible for up to 3 years. However, there is a clause that we can make sure that clause is there for up to 3 years, which would give safety to the buyer. So they would come in and buy it knowing that you are responsible for up to 3 years. So that's how we would leverage that.
If I invest in with my brother-in-law, will I have to make some U.S. tax report? Because it's in the U.S.
Yeah, it's actually it is a very tricky situation. As a Canadian resident, you're going to be taxed on your worldwide income. So you're not only going to be taxed in Canada, but also in the U.S. But the fun thing is that you can claim a foreign tax credit based on taxes that are paid in the U.S. You're actually, yeah, exactly. So you can basically, you have to do both tax returns together so that you can claim the appropriate tax credit in this situation. And there's also the fact that you have an investment in the US means that there's also a lot of forms. If you pay more than $100,000, you actually have to file a T1135 based on your foreign US property so that the Canada can be aware of all of your worldwide investments. Yeah.
So if I understand, with the money I'm gonna make from the sale of my company, I'm gonna put it I'm gonna take it and invest in the real estate.
Yes.
Okay, that's how I finance that.
Exactly. Based on our calculations, just the sale of your business should be enough. We also gave you a few alternatives. You can always you have a lot of excess cash. So and you have we don't know about the capital dividend account. That's really a crucial balance to ask the client the next time we see him. But based on our calculations, just the sale of your business should be enough to finance both investment alternatives. Yeah.
And do you think that the cost for the real estate is valuable? Like, is it a good price, or I'm gonna pay too much, or?
Yes. So for the real estate price, essentially how to evaluate that is to look at the cap rate in the same neighborhood in the center of Quebec City, and to see what price I'm paying for, and to see based on the normalized cash flow that's going to be generated on that to compare the cap rate. Unfortunately, at the moment, we don't really have that. That's why we calculate the cap rate and the NPV to make sure that based on this alternative compared to the US investment, which one has a higher yield. Yeah.
No more questions.
Thank you so much for your time.